Welcome back to the Daily Crypto Roundup. Today we've got a packed one, because the crypto market is being pulled in a few very different directions at the same time. On one side, we're seeing a major enforcement push, with Tether freezing hundreds of millions of dollars in USDT on Tron, and Spanish police seizing hidden crypto wallets in a manga piracy raid. On another side, we've got regulation back in focus in the United States, with more than 100 crypto firms now pushing the Senate to move on a market structure bill that the industry sees as absolutely critical. Then we've got a reality check in Web3 gaming, where more than 90% of projects are now being described as dead after a massive funding boom failed to produce real gamer demand. And finally, we'll get into XRP, because the setup around that coin is getting more interesting again, with regulatory clarity improving, the commodity narrative growing stronger, and ETF access becoming part of the conversation, even while price continues to grind sideways. We'll also touch on Iran pushing back on reports around crypto tolls in the Strait of Hormuz, because that story matters far beyond headlines when you think about oil, shipping, sanctions, and how digital assets may increasingly show up in geopolitical workarounds. Just before we continue, this episode is brought to you by Kraken, our official exchange partner. If you want a straightforward way to buy, sell, and explore crypto, Kraken is well worth a look. And if you'd like to support the podcast, using our link in the description really helps. We're also keeping the 20 XRP giveaway going, so if you want to check Kraken out and support the show at the same time, use that link below. Not financial advice, crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. View legal disclosures at kraken.com. Okay, now let's start with Tether, because this was one of the biggest straight-up enforcement headlines of the day. Tether froze roughly $344 million worth of USDT on Tron, tied to what it described as illicit activity, and the key detail here is that the freeze reportedly happened in coordination with U.S. authorities, including law enforcement and OFAC-linked action. That matters because it reinforces something the market keeps forgetting whenever people talk about stablecoins, like they're some kind of untouchable offshore cash substitute. USDT may move fast, it may be deeply embedded in global crypto liquidity, and it may be used across borders at scale. But if the issuer cooperates with authorities, those funds can absolutely be frozen. This was not some tiny wallet or symbolic action either. This was a massive enforcement event, and it sends a signal both to criminals and to policymakers that centralized stablecoins can still function as compliance tools when the issuer wants them to. The bullish interpretation is that this helps make stablecoins look more legitimate in the eyes of regulators. The bearish interpretation is that it reminds the market just how much control still sits at the issuer level. Either way, it's another example of crypto maturing into a more surveilled and institutionally acceptable system, not a less controlled one. And if you zoom out, that Tether story is also part of a much bigger trend. Over the last couple of years, governments have become much more focused on using blockchain transparency against bad actors, rather than pretending the technology itself can be banned out of existence. That is a major shift. The old debate used to be whether crypto was too wild to regulate. The newer debate is how it gets integrated into enforcement, capital markets, payment systems, and financial surveillance. So when Tether freezes hundreds of millions tied to suspicious activity, it is not just an isolated compliance headline. It becomes evidence for the argument that stablecoins are evolving into something Washington can work with, monitor, and shape. That may help firms pushing for clearer laws, but it also chips away at the old libertarian fantasy that the largest digital dollar in the market exists outside political reach. That flows neatly into the next story, because more than 100 crypto firms are now urging the U.S. Senate to move on a market structure bill. The pitch from the industry is pretty simple. If the U.S. does not create a real legal framework soon, capital, talent, and innovation will keep drifting elsewhere. The priorities being pushed include clearer lines between SEC and CFTC oversight, better definitions around what counts as a security versus a commodity in digital assets, and a more durable framework for builders and institutions to operate under. What's interesting here is that the industry is sounding more united again, at least in public. After a long period where different corners of crypto were pulling in different directions, you are now seeing a broader coalition arguing that uncertainty itself is the biggest drag on growth. And from the industry's perspective, that's not just rhetoric. It affects where companies launch, where investors allocate capital, and whether serious institutions treat US-based crypto as investable infrastructure or as a legal headache. Now, the reason this matters for listeners is that regulation is no longer just some boring side topic that only lawyers care about. It directly affects which coins attract capital, which exchanges grow market share, which products get approved, and whether tokens can break out of these endless range-bound conditions with real conviction. Markets hate uncertainty, and crypto has been swimming in it for years. So, if the Senate genuinely begins moving on market structure, that could be one of the most bullish medium-term developments for the space, even if it does not immediately send prices vertical tomorrow morning. Clear rules do not guarantee a bull run, but they do make it easier for institutions, payment firms, brokers, and public market products to build around crypto without feeling like they are stepping into a legal minefield. That is why this story matters. It is not just politics, it is market plumbing. Now let's switch gears, because one of the roughest stories of the day came from Web3 gaming, where more than 90% of projects are being described as failed after a roughly $15 billion boom. And to be honest, this one is not that surprising if you've been watching the space properly. Too much of Web3 gaming was built backwards. Instead of starting with fun, retention, and gameplay, a huge chunk of the sector started with tokenomics, speculation, and promises of digital ownership that were supposed to magically create engagement. But gamers did not show up in the numbers needed, and many of the ones who did were there to farm incentives, not to stick around long-term. That is a brutal foundation for any industry. If your user base is mostly there for token upside rather than actual enjoyment, the moment token prices collapse, the ecosystem hollows out. And that is exactly what happened across a lot of GameFi. The deeper issue here is that Web3 gaming exposed one of crypto's oldest weaknesses, which is the tendency to assume financialization automatically creates product-market fit. It does not. Adding a token to something does not make people love it. Adding NFTs does not create a healthy community. And building an economy before you build a compelling game usually ends in a ghost town. According to the reporting around this story, token prices in the sector have been smashed. The majority of projects are effectively dead, and the funding boom of previous years simply did not translate into lasting player demand. That does not mean blockchain gaming can never work. It means the first big wave was mostly overfunded hype meeting underwhelming execution. The survivors will probably be the teams that treat crypto as supporting infrastructure rather than the whole reason the game exists. Now let's get into XRP, because even though price action is still frustratingly sticky, the narrative around the asset is getting stronger in a few important ways. The reporting today highlighted that XRP has historically performed well in April, that it is trading in a stubborn range around the mid-$1.40 area, and that support around 1.30 to 1.35 remains important, while resistance near 1.50 to 1.52 continues to cap the upside. More importantly, the backdrop is improving. The SEC's case against Ripple has been dropped. The token is now being discussed in a more commodity-like context. Ripple's institutional settlement pitch remains alive, and there is a sense that ETF rails and broader access could become part of the story over time. The article also noted that derivatives open interest remains below prior peaks, which means there is still room for a sharper move if the market gets a real catalyst and that resistance breaks with volume. What I think is especially important here is that XRP is moving from a survival narrative back toward a utility and access narrative. For a long time, XRP's identity was basically trapped inside the lawsuit. Everything came back to that case. Every rally, every sell-off, every debate. But once that overhang starts fading, the market begins asking a different question. And that question is not just whether XRP can legally exist. It is whether institutions, payment rails, and financial products might actually build around it in a more serious way. That does not mean price explodes overnight. Clearly, it hasn't. But it does change the quality of the conversation. And when you combine that with historical April strength and a chart that is pressing against a key ceiling, You can see why traders are watching that 1.50 zone so closely. If that breaks cleanly, sentiment can change quickly. If it fails again, the frustration probably continues. Another story that caught attention today came from reports around Iran denying that it is already collecting crypto tolls in the Strait of Hormuz. Iranian state-linked media rejected claims that Tehran was already demanding Bitcoin or stablecoins from vessels, while maritime security firms have also been warning about scam emails demanding crypto clearance fees. The broader context, though, is what really matters. Reports had circulated that Iran was considering tolls equivalent to around $1 per barrel for oil transit through the waterway, which could amount to tens of billions of dollars annually if such a regime ever became real. So even though Iran is denying current crypto toll collection, the fact that this conversation is happening at all tells you something important. In moments of conflict, sanctions pressure, or financial fragmentation, crypto keeps appearing as a possible workaround mechanism in areas tied to trade, shipping, and state-level strategy. That does not mean every headline like this is true. Clearly, some of them are not. But it does mean crypto is increasingly part of the geopolitical imagination. And when an asset class becomes part of how markets think about sanctions evasion, emergency settlement, toll collection, or cross-border workarounds that has consequences. It may create demand in some circumstances, but it also guarantees heavier scrutiny from governments. So the Iran story is another reminder that digital assets are no longer sitting off to the side as a niche speculative playground. They are being pulled into energy politics, maritime risk, and the broader machinery of global finance. And finally, there was a strange but telling enforcement story out of Spain, where police seized around 400,000 euros in crypto stored in cold wallets, hidden inside a wall-mounted thermometer during a manga piracy raid. Authorities said they had dismantled what they described as the country's largest Spanish-language manga piracy site, arresting 3 suspects in Almeria. The platform had allegedly been running since 2014 and generated more than 4 million euros in ad revenue. It is one of those stories that sounds bizarre on the surface, but the underlying lesson is straightforward. Crypto is now a normal part of criminal investigations, asset seizures, and hidden wealth discovery. It is no longer some novelty. Law enforcement expects it to be there, knows how to look for it, and increasingly knows how to seize it. So when you put all these stories together, the theme today is not just price. It is crypto becoming more embedded in the real world, and with that comes both opportunity and control. Tether freezes show stablecoins can be powerful compliance tools. Senate lobbying shows the industry is desperate for legal clarity. The collapse in Web3 gaming shows hype alone cannot manufacture demand. XRP shows what happens when an asset starts to escape a long legal shadow and rebuild its case on infrastructure and market access. Iran-related reporting shows crypto drifting closer to geopolitics. And the Spain seizure shows that hiding value in cold wallets is no longer enough to stay invisible forever. That's it for today's roundup. If you're watching XRP, keep an eye on that resistance zone. If you're watching regulation, the Senate is back in focus. And if you still think crypto is somehow separate from the real world, today's stories should make it very clear that it isn't. As always, we'll see you at the top.